Recently, a large crowd of account holders gathered at the entrance of an agricultural bank in Bazhong, Sichuan Province. Among them, a distressed woman lamented that she couldn't withdraw her life savings of 660,000 yuan, as the bank informed her that it had been converted into a financial product. Overwhelmed with grief, she found it hard to accept that the hard-earned money she had accumulated over her lifetime had mysteriously disappeared. This agricultural bank's operation closely resembles that of the Henan and Anhui rural banks which collapsed last year. The victims from those incidents are still trying to reclaim their deposits. Initially, such occurrences were limited to rural banks or small city commercial banks, but now they are starting to appear even in large state-owned banks. The video shows a woman narrating her ordeal at a branch of the China Construction Bank in Yuzhou City, Henan Province. Her fixed-term deposit in the bank upon maturity was unable to be withdrawn. She went to the bank to check, but found that her money had been transferred out of her account and was used to purchase real estate bonds.
你看这是咱禹州的建设银行啊，当初俺就是搁这儿存的钱，存的定期，这张也到期了，取不出来了，然后找银行，银行说，赶转到俺的钱被转走了，转成那什么债券、房地产了，俺老百姓不懂这事儿，因为现在一出事儿，员工找不着，领导找不着，找谁找，真是老百姓有苦难言。
Many other clients of the bank experienced the same issue, being unable to withdraw their deposits. During discussions with bank employees, they were frustrated to learn that the individual who previously helped them was not an employee of the bank. Some people said that they had all done their deposits here, and asked whether there was any surveillance equipment in place where they had done their business at the time, and requested to check the surveillance video for proof. The bank employee responded that the situation was complex and needed further verification. The account holders, unsatisfied with the response, put up banners at the bank entrance accusing China Construction Bank of fraud.
禹州健康是骗子，存钱取不出来了，还我血汗钱，还我血汗钱。
银行的门头得拍上哈。
禹州健康是骗子。
It's not only withdrawal issues, a large number of bank cards have also been frozen without reason. At an agricultural bank branch in Zhongshan City, Guangdong Province, many people were seen queuing to unfreeze their bank cards. Indeed, starting from last year, not only numerous rural banks, but also several large state-owned banks such as China Merchants Bank, ICBC, China Construction Bank, Agricultural Bank, and Ping An Bank have been reported to freeze accounts unreasonably. Account holders are unable to make transactions or withdrawals. What they can do with their accounts is deposit money. This suggests that even if the money is deposited in these large state-owned banks, the security of the account holders' deposits is still not guaranteed. Many banks have also placed withdrawal limits, or set up various obstacles to prevent account holders from withdrawing their money. This phenomenon has been occurring on a large scale since last year. In fact, we are aware that since the meltdown of the rural banks in Henan last April, various issues have continued to plague China's banking industry. These include a large number of rural and city commercial banks falling into crises or even going under, as well as several state-owned banks beginning to freeze bank cards and impose withdrawal restrictions. While these issues are yet to be resolved, another significant signal has recently emerged in China's banking industry. On July 4th, Goldman Sachs issued a ratings adjustment report on the Chinese banking industry, rating 12 state-owned banks and some joint stock banks. Industrial and Commercial Bank of China, Agricultural Bank of China, Bank of Communications, Industrial Bank, and Huaxia Bank were all downgraded to sell. Bank of China and China Merchants Bank were given a neutral rating. The only banks remaining with a buy rating were China Construction Bank, Postal Savings Bank, Ningbo Bank, and Ping An Bank. The report led to a 2.49% drop in the Hong Kong Bank Index on July 5th, suggesting that investors are indeed selling off Chinese bank stocks. The decline in mainland A shares was less severe, with the bank index only falling by 0.52%. Of course, it is understood that mainland institutional investors cannot short their domestic bank stocks based on adjustments by overseas rating agencies. The Goldman Sachs report touches on three aspects, all related to the debt of China's local governments, which primarily consists of bank debt. The combined local government debt on the balance sheets of the 12 banks specified in the report is about 34 trillion yuan, accounting for 61% of the bank's assets. These banks are deeply involved in local bonds and carry numerous hidden bad debts. If these bad debts explode, it could lead to asset devaluation and decreased profits. Hence, the Goldman Sachs recommended to sell their stocks. Goldman Sachs released the report because there have been multiple indications that, in recent months, several state-owned large banks have started issuing 25-year loans to local government financing platforms that meet the requirements. Furthermore, neither principal nor interest are to be repaid in the first 4 years. A 25-year term is considered a super long-term loan, as the majority of current business loans have a 10-year term. Local financing platforms are urban construction investment companies established by local governments for local infrastructure construction, commonly known as urban investment companies. On paper, these companies owe the debt, but local governments, as the initiating and primary shareholders, bear the indirect responsibility for repayment. In addition to urban investment bonds, government debt also includes a large amount of special bonds and other debts. A Goldman Sachs report stated that Chinese local governments currently have to use 15 to 20% of their fiscal income to repay debt interest. Essentially, so much money is being used just to pay off interest that many local governments are practically on the verge of collapse. The previous defaults of Guizhou and Jiangxi governments serve as examples. In many countries, local governments can technically declare bankruptcy, but this is not feasible in China. China's executive-dominant social structure, in which central power dominates absolutely, would lead to incalculable consequences if a government runs out of money or faces problems. In recent years, we have often seen news about pay cuts or wage arrears for civil servants and teachers, but these are sectors that do not greatly impact social stability. However, if wages for city management and public security, a series of social stabilization enforcement governing organs, cannot be paid, it would shake the power stability of the Chinese Communist Party, which is unacceptable to them. This is also why local governments are not afraid to borrow money, as the central government ultimately has to take responsibility. Additionally, if there were substantial defaults on local debt, it would lead to a lethal blow to the financial system's stability. So the problem of local debt must somehow be addressed, even if it's just pushing the risk into the future to temporarily alleviate immediate concerns. However, the finance department of the central government does not want to directly rescue these almost bankrupt local governments. If the aforementioned news is accurate, then the enormous risk of local debt has been shifted onto the banks, burdening them with this liability. It is akin to the banks taking on a significant amount of extremely long-term, high-risk loans with extremely low yields, and not receiving any return for the first 4 years. Would the bank sector be willing to shoulder this burden? Of course not. Therefore, there is a change of personnel at the higher levels of the People's Bank of China, or PBC. The previous party secretary of the PBC, Guo Shuqing, the governor Yi Gang, and other leaders are largely finance professionals. They know that if banks shoulder such a burden, it could lead to serious problems in the future. Not just for the banks, but also for the Chinese economy, so they might oppose it. However, under the current Chinese model where the party controls everything, any official must obey the orders of the CCP. If they don't, they will be replaced. This is why we see Pan Gongsheng has recently become the party secretary of the PBC. There are rumors that the PBC governor Yi Gang will also be replaced soon, possibly with more obedient successors. By the CCP's convention, the PBC governor or the party secretary should be at least at the level of a central committee member of the CCP, or at least an alternate member. However, it has been noted that both of the current governor Yi Gang and the newly appointed party secretary Pan Gongsheng are not among the 376 central committee members or alternate members. This suggests that the PBC leader's status within the party is declining. The Nikkei reported that Yi Gang and Pan Gongsheng don't have much decision-making power on important matters. Instead, Xi Jinping's confidant He Lifeng actually controls the financial power. Chinese Vice Premier He Lifeng has known Xi Jinping for 40 years. The Washington Post reported that Dennis Wilder, a former CIA analyst who provided China policy advice to President George W. Bush, said, he is a protege of Xi Jinping, which means that He Lifeng understands Xi Jinping's thoughts better than anyone else, including Premier Li Qiang. Regardless of what Xi Jinping asks him to do, he would do it without any hesitation, said Wilder. As part of the institutional reforms announced in March, the CCP established the Central Financial Committee. The committee is seen as a financial control tower, responsible for researching and deliberating on significant financial policies and key issues. According to reports, He Lifeng is responsible for the establishment of the committee, and the position of chairman is currently vacant. The newly appointed vice chairman, Wang Jiang, who was appointed on May 16th, was a doctoral classmate of He Lifeng at Xiamen University's School of Finance and Economics. So, He Lifeng is currently perceived as the one replacing the central bank's control and truly holding financial power. It can be said that the financial sector in China is ultimately controlled by the Communist Party. Essentially, all banks in China are policy banks. They cannot manage their business based purely on profitability, but must operate according to the needs of the CCP. If the communist government dictates who to lend to, the banks have to comply, regardless of how absurd it may seem. So, what consequences would it bring if banks indeed end up playing the role of a catch-all for local government debt? Guo Jun, editor-in-chief of the Epoch Times, stated in the Elite Eliters Forum that bailing out local government's finances through banks is the lowest-cost strategy for the Chinese Communist Party. However, for the banks, it could be a deadly blow, and for the macroeconomy, it might even be a suicidal act. If these commercial banks are forced to lend to local governments now, it's equivalent to taking the bank's money for local government use. Plus, they don't have to pay interest for 4 years, which is effectively a forced transfer of banks' profits to local government finances. The entire profit of the Chinese banking industry in 2022 was approximately 2.1 trillion yuan, with the 6 major state-owned commercial banks accounting for about 1.35 trillion yuan. If the central government requires long-term lending to local governments, which Goldman Sachs suggested could be as much as $9 trillion or about 60 trillion yuan, this interest-free borrowing from local governments would be significant. Assuming a smaller scale, let's say 20 trillion yuan is lent to local governments, this interest, calculated at 1% rate, amounts to 200 billion yuan annually, and at 2%, 400 billion yuan. This is the bank's interest loss. Additionally, there is an opportunity cost loss. If all this money is given to local governments, it cannot be lent to others, and there will be no way to lend to enterprises. In 2022, the total loan amount of China's bank social financing was only about 32 trillion yuan. If this 20 trillion is given to local governments to fill the gaps, it would be a significant tightening of monetary policy, causing China's economy to slide rapidly. Hence, using bank loans to repay local government debt is essentially a temporary solution. If there's a major issue with China's banks, US capital will naturally react. They may reduce their holdings in the market or make other moves and adjustments. However, this is just a minor reaction from foreign capital at the moment. If the CCP continues along this path, it's estimated that the next step would be to downgrade the credit rating of China's banks. Their bonds could potentially be classified as junk bonds, causing the cost of overseas financing for Chinese banks to rise significantly. According to the analysis of a financial blogger, Mr. Man, in China, no matter what bank you look at, the net interest margin is just over 1%. During the US interest rate hike cycle, China had to continually lower loan interest rates to stimulate the economy. However, due to fear of triggering public panic, it dared not significantly reduce deposit interest rates. This has led to universally low profit margins for banks, all struggling to maintain a balance between revenue and expenditure, leaving no room for concessions. At this time, if banks are asked to provide large-scale interest subsidies to local governments, the banks will not be able to cope. They would not be able to survive for a year, let alone 4, and certainly not 25 years before recouping their principal. According to his estimates, if this absurd method is employed, once the amount banks subsidize local governments exceeds 500 billion yuan, the banks will plunge into massive losses. Banks cannot operate at a loss. To stop the losses, they would have to recall loans. But they cannot recall preferential loans from local governments, so they would have to recall loans from ordinary people. If the public cannot repay the loans, then a financial crisis would ensue. He believes that if China continues down this path, the economy would not last until the end of the year. Chinese current affairs commentator Zhao, on the other hand, believes it's not entirely accurate to say that the risks of city investment companies have shifted to the banks. When the borrowers can't repay the money and the banks are riddled with bad debts, the government cannot possibly let the banks go bankrupt. So, what to do? The money that the public has deposited in the banks can be considered as their contribution to the country, so perhaps they shouldn't withdraw it. It's not that your banknotes become void, but there are ways to make them practically void. For example, locking your savings account for 20 years. If you're still alive after 20 years, come and withdraw it. If you're dead, your descendants can withdraw it. Therefore, ultimately, the burden will fall on the Chinese people. They will be the ones paying the bill, the chives who end up bearing the risk. If the banking industry gets a worse outcome in the local debt situation, then the ordinary people get the worst outcome. Therefore, the scenes we saw at the beginning, depositors' savings accounts being frozen, taken to purchase bonds, withdrawal restrictions, and other chaotic phenomena, will become increasingly frequent in major banks.